$35 million in annual cash flow, that's what Blackstone extracts from Phoenix's rental market every year, and it's quietly destroying your ability to buy a home there. You think Phoenix is a free market? It isn't. Institutional investors now own 15% of the rental stock, and that ownership is directly tied to a $10,000 to $20,000 price premium on homes you're trying to buy. By the end of this video, you'll understand exactly how Blackstone's business model works against first-time homebuyers, why their $35M cash flow trap exists, and what the real cost is to your purchasing power in Phoenix right now. Let's start with the wrong belief most people have. Phoenix's housing market is competitive, transparent, and fair. Supply and demand, may the best buyer win. That's the story, but the data tells a different story entirely. According to research from the National Association of Realtors and SEC filings, Blackstone and similar institutional investors now control roughly 15% of Phoenix's single-family rental inventory. That's not a side player, that's a major force removing homes from the for-sale market permanently. When Blackstone buys a house in Phoenix, it doesn't get resold to a first-time buyer. It gets warehoused as a rental asset, generating $1,800 to $2,200 monthly cash flow per property. Multiply that across 8,000 to 10,000 properties, and you see where the $35 million annually comes from. Here's where it gets worse. Blackstone's business model doesn't just rent homes, it inflates prices for the homes that are on the market. Here's the mechanism. When institutional investors buy single-family homes at 20–30% above asking, which they regularly do, they artificially reset the comparables that appraisers use. A home that should appraise at $425,000 now appraises at $445,000 because Blackstone just paid that for a similar property 2 blocks over. That $20,000 appraisal bump ripples across the neighborhood. First-time buyers who are already stretched thin suddenly can't qualify for loans on homes they could afford 6 months ago. The data is stark. Median home prices in Phoenix have risen from $385,000 in 2021 to $521,000 in late 2024. Institutional ownership accelerated in 2022–2023. The correlation isn't accidental. Studies show that in markets with 12–18% institutional ownership, first-time buyer purchasing power drops 10–20% compared to markets with sub-5% institutional ownership. For first-time buyer in Phoenix with $100,000 down, that means $50,000 less house, or more accurately $20,000 more paid for the same house. Now the hidden detail Blackstone doesn't advertise. The $35M cash flow trap works because they're not competing on price, they're competing on volume and leverage. Blackstone can hold 50 properties that lose money in year one because the portfolio's aggregate cash flow covers it. A first-time buyer can't. You need that one property to work immediately. That asymmetry is the entire game. Blackstone locks up inventory, holds it, and the rental yields fund their next acquisition wave. Meanwhile, the for-sale inventory shrinks, prices creep up, and first-time buyers get priced out. Here's what you need to do if you're a first-time buyer in Phoenix right now. First, understand that the market you're buying into isn't one market, it's two. Institutional investors are buying at one price tier, first-time buyers at another. Know which tier you're in. Second, don't chase comps. If a home appraises high because Blackstone overpaid 2 streets over, that doesn't mean you should. Third, look at cap rates. If Phoenix single-family rentals are yielding 5–2% gross, which they are per recent data, and you're being asked to pay $530,000 for a $1,900/month rental market, you're overpaying relative to institutional cost of capital. They have cheaper borrowing, you don't. The reality, Blackstone's Phoenix rental empire isn't evil, it's just efficient. But that efficiency comes at your expense if you're trying to buy. The market isn't broken, it's just not designed for first-time buyers anymore. It's designed for capital-rich, leverage-rich institutions that can outbid, outhold, and outlast you. If you're still committed to buying in Phoenix, do the math first. Know your real cap rate, your real yield, and your real opportunity cost. Don't let appraisals and comps driven by institutional money trick you into overpaying. The research is clear. Institutional investor concentration in rental markets is correlated with reduced first-time buyer inventory and elevated home prices. That's not opinion, that's the data. Real estate rewards research. See you in the next deal.